everybody. Before we jump into today's episode, we have two sponsors we want to say thank you to for supporting this show. The first one is Routine. You guys have heard me talk about Routine, honestly, back from the early days of the podcast, and it's still a product I use every single morning. They have a prompt for me here. I'm going to do a little impromptu on this ad read today because honestly, this is a product that I truly believe in. And so I'm just going to tell you guys exactly what I think and why. First and foremost, this is a stat that they shared, but when you sleep, you lose between a pound and a half of water. And most of that's just sweating while you sleep. I used to not know if that was actually true, to be honest. I felt like a pound to a pound and a half of water seemed like quite a bit while I slept. But the one thing I did constantly pay attention to when I started using Routine was just the fact that before using Routine, I always felt a little dehydrated in the morning. And I'm one of those people that when I get up really early usually. I work out. One of the first things I do is some form of fitness. It's just like what I do before everyone's awake. And so it's very easy for me to grab a coffee, pre-workout, an energy drink, something with caffeine in it, and just go. When I am good about using Routine, first, I basically they come in these little single serve packets. They contain half an organic lemon, a tablespoon of apple cider vinegar, Himalayan sea salt, all 6 essential electrolytes, and they have no sugar in them at all. A lot of hydration products are going to have sugar. So one of the things about Routine that I love is that there's no sugar in there. So when I am good about doing this consistently, I will take one of those single serve packets, I'll throw it in my mixer bottle, and whether I also put in a pre-workout or something with caffeine or I just drink that separately, I try to drink that first. And the days I do that, I do genuinely feel hydrated and just have a different form of clarity all morning. A lot of people have tried to make their own homemade versions of Routine, right? You see people they take a shot of the apple cider vinegar, they put a little sea salt, a little lemon in a drink. This is essentially that, but in a product that you can take with you on the go, have it ready for you first thing in the morning. I know me personally, when I'm groggy rolling out of bed, the last thing I want to do is, squeeze a lemon, cut lemons up, go get the apple cider vinegar, find my sea salt. I just rip this packet open, throw it in my water, drink it, and it's good to go. You can try yours today. If you haven't tried it yet and you've been listening to this podcast for years, just try the damn Routine. Give it a shot. You can use code ShaneWhite30 and get 30% off your first order. So you get 30% off by using code ShaneWhite30 and go to yourroutine.com. To make it even easier, I've added the link to yourroutine.com in the show notes. So just click on the show notes for this episode, click on the link to yourroutine.com, and don't forget to use code ShaneWhite30. All right, guys, today's episode is also brought to you by NeuroRoast. Again, I'm going to go a little off script here. NeuroRoast is a product that I also came across during this year of 2023. They are a coffee company that's helping you optimize your brain function and overall well-being. This is another product that, to be honest with you, when I first started working with it, I was a little on the fence. I was like, do I really want to have mushrooms in my coffee? Well, folks, I will tell you, when I use NeuroRoast, one of the things that has stood out to me the most is I'll back up. People that know me know that I have way too much caffeine, typically. One of the things this year I've done a good job of is cutting out alcohol. Not completely, but predominantly, I don't touch a lot of alcohol anymore. What I think I've actually done the other way, though, is add a lot more caffeine. So I do definitely drink too much caffeine. That's something I need to work on next year, is to try to minimize how much of that. But NeuroRoast is something that has actually helped me because of the way they've formulated their coffee. Like, unlike regular coffee, which is, still something I consume, but NeuroRoast specifically doesn't cause jitters or crashes. Mushroom coffee provides more balance and sustained energy, allowing you to stay focused and productive throughout the day. So the times I do use NeuroRoast, I'll be honest, I just don't feel that jittery, like, I'm jumping out of my chair or standing here at my desk jumping around feeling. So give NeuroRoast a try. They have some really good flavors. I'll be honest too, the two guys that started NeuroRoast are just really good dudes based out of New York, and they're hustling, and hopefully they can get some people to try NeuroRoast this holiday season by listening to this podcast. So for you folks who've been on the fence, I'm telling you, it tastes delicious. They've done a fantastic job of making this coffee not only be functional, but taste fantastic. And if you want to try NeuroRoast, you can use code ShaneWhite. So it's super simple, just ShaneWhite at checkout. you'll also get 30% off. So if you go to neuroroast.com, and once again, I have added that to the show notes. So just click into the show notes while you're listening to this episode. You can click on NeuroRoast link directly. Don't forget to use code just Shane White, and you'll get 30% off your order. Hope you guys love both these products. I'm trying to not only bring you guys products that I use, but that I believe in on the podcast. I'm not taking ad reads for any brands that I don't really believe in. So anyway, hope you guys love both those products, yourroutine.com and neuroroast.com. I've added those links to the show notes. I hope you guys love it. And I got an awesome guest coming up right after this. All right, everybody. Welcome to another episode of the Shane White Show. If you're watching, this probably looks a little different. I was telling Scott before we hit record. I've been not banished is the wrong word, but I'm in my basement home gym recording this today because getting some work done in the office. But I am pumped today. Scott, this isn't your third time, right? Is it your third time coming on the show?
I think it is. I'm excited.
Yeah, you're only one of maybe two people that have been on here 3 times. So thank you for doing that. I appreciate it. Obviously you like me a little bit to come back for a third time.
Thanks for having me.
Twice is like, you got it. Like, you're like, I should come back. He asked me. 3 is like, you could easily say, I'm busy. Anyway, for everyone listening who didn't listen to the first 2, Scott Bennett, welcome to the show. I'm pumped to have you back. Scott is always my resident. If I have anything stock market related, public markets related things I'm thinking, I shoot Scott an email. Do I have your phone number? I always think I shoot you emails with like my personal email, which is the one I'm not great at checking. I should just get your phone number. We could talk more. Anyway, welcome to the show. This is the longest introduction of all time. Scott, welcome to the show. For everyone listening, Scott, do you mind giving everyone just a quick intro to you, your background, what you do, and ultimately Invest with Rules and what you're doing now with Advisor?
Yeah, absolutely. Well, I guess I'll go back in the time machine really quick. My background, I worked at Fidelity Investments, the amazing green machine behemoth, for a little over 16 years. They are a wonderful place. I still I hold my and clients' assets there. They're a great place. And I worked there for 16 years. I was and still am a certified financial planner. I am a huge student of the market. And over my journey, I've seen a lot of investors make a lot of mistakes. I was guilty as well. Down markets. So if you kind of rewind back to 2022, you rewind back to COVID when we first started talking. I love looking at your portfolio. And I was face to face with clients in 2008, and that was really rough, where I was in charge of about $2 to $3 billion of clients' money as their advisor. And it was really a pretty challenging experience as they were losing large sums of money. And I went on this massive journey personally and in the company of like, well, what else is out there and what else can I learn? And I eventually left Fidelity. And I started an investment newsletter called Invest with Rules. And it's a couple of rules that can set any investor to kind of remove themselves from the massive emotions that come when things aren't working. Or when things are working, you're feeling a little too good. Or when things aren't working, you're feeling absolutely horrible. So we'll go through those. But in general, it's follow the trend, follow big money because they move the market, and follow risk management rules to not let something like a small loss turn into a big loss. So using this philosophy, the newsletter is a kind of video and it's also pretty prescriptive. So it's a newsletter called Invest with Rules. And then as well, on a totally separate note, similar strategy. We do help clients. I run an investment advisory firm with my business partner, and it's been really fun. So it's been, that business is over a year old, and we are helping a little over 20 families, and it's been super fun. That's my background.
That's awesome. Is the we're going to dive into all of this for everyone listening, but the advisory firm, I have to ask, I just think that's like the coolest thing. Like I think we talked about this maybe even on the first podcast. I've always joked with friends and family, like I am absolutely not at the level you are of knowing things, but I'm always like, I feel like when you're someone who is so interested in the market and you just genuinely love watching it, learning about it, critiquing it, being able to do that for I've always, like I was very close to going into that versus corporate finance. I was very, very close. So for you, I mean, what was kind of the tipping point to want to go into that? Was there like a big reason or want? Because obviously, I'm sure there's a lot that goes into that. I'd love to even unpack that a little bit, but would love to know what pushed you into doing it.
Yeah, and I think the main catalyst was any process. We're human. We go on vacations, we check out, and usually I think the hard part is our newsletter did really well in 2022 when the market was down almost 20% that year. And I was surveying a ton of my members, and I was learning that they were hanging on to positions too long. They got busy, and they were kind of like cherry picking certain items. And I take a ton of pride in how they're doing and their results. And I just kept thinking like enough people during these conversations were like, hey Scott, this is great, but can you click the buttons? I have other things to be doing with my daytime. So
Right.
I'd rather
Right.
go on vacation. So very simply, enough people raised their hands. I did a massive amount of due diligence because I take this so seriously. I mean, this is people's net worth. This is their retirement funds. This is no joke. And we did an enormous amount of back testing to start the newsletter. The newsletter is kind of like an open game of cards where people can see everything I'm doing over my shoulder. So it gave me a lot more confidence to pull the trigger and help people more.
That's awesome. Yeah, I was gonna say, and it seems like such an organic expansion into like from what you were doing with the newsletter, and obviously like I watch and listen and read the newsletter to then be like, oh, and if you really want to get into this, like let me help you in a bigger way. It seems like such an organic, obvious expansion of what you were doing.
Yeah, and one of the coolest things, so the newsletter is really fun. And the thing that gives me the most like joy is we are helping people in good and bad markets. But what's super fun that I was really not doing to a full extent before was like really stretching my certified financial planner. So we review people's taxes now. We review people's insurance, and it's all fiduciary. It's all in the client's best interest. So there was parts of people's lives that we can go way deeper and kind of coordinate, like when your CPA is amazing, but they really just file your taxes. So it's like
Sure.
maybe you're missing things. So that's been way really rewarding for me personally.
Oh yeah, I bet. I mean, because that's more of now you're taking not just the stock market and someone's investment or retirement, but you're actually like full financial picture for folks.
Yeah, and from our quick conversation, like when you're helping brands yourself, you're not just like having a conversation. You're actually looking at their profit and loss statement and their balance sheet, and you're like, you're in. I mean, you're in this with them.
Yeah, 100%. Yeah, it's a big difference, right? If you can like talk the talk and walk the walk and explain, like you understand more than just one piece of it, the whole pie, I think it does actually make a really big difference, even in the relationship. Because it's funny, like I could see it's someone who maybe subscribes or pays for the premium newsletter, and then now you're managing more of it. Like, I mean, they just trust you. Like, they just know you're paying attention. I think that's the one thing that really has changed my mind over, I would call it probably the last 5 to 6 years. Before COVID and having like a regular W-2 job, I always was anti like working with anyone with my money. And I'm trying to think back. I don't really know why. I think it was just being a cheap ass and being like, I don't want to give a percentage or a dollar amount away to someone. Like, I could do this. I'm looking at it. But then as you get busier, and like we talked before the podcast, like if I fast forward from back then to now, like a house, kids, a business, like you just don't have time. There's not enough time in the day to do half the stuff, let alone like actually wrap your head and make good decisions with something as important as your long-term wealth. So I totally get it now. What is it like to actually start? So like this advisory firm you start, I'm sure there's a ton of red tape. There's got to be a ton of process. Like what does it take to actually like, okay, Scott and his business partner today are like, we want to start this, to like, are there like a ton of certifications? Like, what do you have to do to even start one?
Well, it's a good question. So having the certified financial planner designation, which is like years of schooling and then a really massively challenging test. So that gives you, all of my old Fidelity licenses are gone as I left, but that one allows you to be registered with the state or the SEC. So that's your credential. If you don't have that, you'd have to take a financial licensing test. So the first step is like, you have to allow the world of the financial state or Fed to watch you like a hawk. Look at your personal balance sheet, make sure that you're on the up and up. That's kind of phase one. You need someone to
Wait, can I unpack that? So do you have to like openly tell them you want to start a firm and they have to like kind of audit you?
Yeah. So we hold assets at Fidelity. So I know for sure Fidelity looks at my credit and they look at my accounts and yeah. State, I believe, did a background check as well.
Okay. Okay.
I know,
Okay.
granted, I've been through that before working at Fidelity for whatever it is, 16, 17 years. So that's pretty, it's, I mean, I would say that's important. No one wants a Bernie Madoff
Sure.
playing around. So,
Yeah. 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 Yeah.
so I would say that's kind of phase one. Phase two is you have to register, which is a process with the state or the SEC. Most people go with the state because they're not running a ton of money when they start. You have to get on someone's custody platform because you're not holding the money. You're either holding it probably at like a Schwab or a Fidelity or somewhere like that. So everyone's just vetting you, and it takes time and it takes money.
Sure.
And you go from the newsletter is a little bit of Fidelity is super restrictive. The newsletter is the Wild West where you can say what you want. And now you're kind of a little bit back in a very compliance minded world where everything is just oversight, protection of you and your clients.
Oh, wow. Yeah. 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 Right. So, okay. And running the newsletter and saying all the stuff like this podcast, for example, I say whatever the hell I want. Does that have any impact when you were trying to set this up? Like, were they reviewing it and asking questions or anything? Like the people that actually give you the green light? Is that like,
Well,
I'm just curious. That seems
no,
like
it's
such
a great
I
question.
never thought about that.
I am my own chief compliance officer. So
Okay.
I won't go off the rails, I promise. I'll be very clear that everything we're going to talk about is not advice. I don't know your financial situation. There's risk investing, manage your risk, manage your stops. This is, if you blindly invest at some point,
Gambling.
even if you buy a super large cap index and you're told that Warren Buffett says it's totally cool, you could wake up in 2008 and lose half your money. So as long as you mentally compartmentalize some of that, then I've done my due diligence.
Got it. Okay. No, that makes sense. That's awesome. Thanks for the background. I've always been curious because it's like you hear about whether it's, advising or even like investments like private equity or funds. I'm always like, I've never understood how they get started. And I assumed it had a lot to do with the SEC and other licensing agencies and needing something like you just said. So that makes sense. Very cool. Well, I think it's awesome, by the way. I know we said that before we record, but very cool for you because I could see that through the newsletter. I'm like, Scott's so good at analyzing this stuff and then articulating it. I'm like, he's got to be having so many people knocking on the door being like, excuse me, sir, love the newsletter. I'm using it to help, but like, can you just do this for me? So that seems great. I'm pumped for you, man. That's awesome.
Thank you. That's awesome.
Have you enjoyed it? I mean, it sounds like you have loved it. Has it been a good leap for you?
It's really awesome to, like, this morning we presented, well, first the client's in phenomenal shape, but just an amazing couple, amazing family. And we went really deep on tax strategy and specifically looking at this particular client has real estate and one is a pretty non-performing asset. So if you think about like some people have like these amazing Airbnbs that are working like clockwork and some people really don't. And then you're like, how much money is tied up in something barely performing? And then people don't want to think about this, but things break. People ruin stuff. So it's like there's always expenses on the back end that you really don't think about too often, except if you're really going through the spreadsheet. So we're looking at projections to retirement. We're looking at projections of his cash flow of real estate. Is that really effective for them? And it's totally their call. It's their plan, but we're just trying to provide as best advice as possible. So it's really fun.
Yeah, that is fun. Because I mean, you then make an impact on not only that couple or that individual, but like their family and like the next generation potentially too, right? I think that's what's cool. That was like, I guess I didn't articulate very well. A couple of years ago, when I met the guy that I work with, it was just like a light bulb for me of like, oh, like it's putting someone on your team is the best way. It's like, it's no different than having like a really good CPA or having a really good lawyer or having just someone that you can pick up the phone and they can like help you when it comes to your life. I'm like having someone in your corner that's a money person. I know for me, it's just been like eye opening to realize like having someone to be able to have that conversation that you just talked about. You think about it. I think we talked about this even on the last podcast, even some of the fun money stuff that I have like in my Robinhood account. I look back and I'm like 5 years ago, I'm like, why was I not taking more risks? You know what I mean? And you think about if you meet the right money person early enough in life, how different your trajectory can be just by doing some like smart things. Like it's not even rocket science stuff. I just think like you guys have, your world is so, if you meet someone good, I guess I've never obviously dealt with a bad one, but you can unlock so much for people just by just telling them and teaching them things that actually help move the needle for them long term. And then it all just builds on each other.
Yeah. I would say the things that are really like interesting for most, like if I thought about my old self, Like when I applied for my benefits at the corporate world, like half the time you're like, this one and this health savings account and these disability, and you're like, huh, do I need that? And then on top of that, you're like, do I have like, you have a home, you have a family, do I have like little bits of like super low cost effective insurance or insurance to protect you on your house? And you're like, I don't know what I'm doing. And now going down this road, like what makes us different is like that, like solving like small things. But then it's like, because we are a trend following belief system, when a year like, I'll go back to the newsletter that was around then, when a year like 2022 rolls around, there's a lot of comfort to know that, like, I'll give a really good example. The bond market. So interest rates went from, in the federal level, to like short-term rates, 0 to over 5. And for everyone that now has to go buy a home, the mortgage interest rate's pretty miserable comparative to what was it like recently. So you sit back and you're like, we can actually help people. There's a lot of things to invest in, whether it's the things you were buying back in 2020, but do you always need to be in everything? Bonds have been a really lousy investment for the past 3 years. And that's where most people's portfolio is. It's like stocks, bonds, cash. So if something is in a sustained downtrend, we don't necessarily have to be in it. So we live in a world of commission-free trades.
Right.
We trend follow, and the trend is maybe the low is coming any moment now. But the reality is it's been in a miserable downtrend. And that's kind of fun, where you get to avoid car accidents that you see coming pretty easily.
Okay. Makes sense. Yeah. It's funny. You say that, and I'm thinking to myself, as I like to think of myself as a finance person. Like I know so little about bonds and the bond market. Could you get, like, anyway, if I'm thinking that, I'm sure someone else listening to this might be thinking the same thing. What's the major reason for that? Just it's purely based off of the interest rate situation. Like that's what drives the bond market in general, or is there a lot? I'm sure there's a lot more to it than that, but
the bond
is it the biggest thing?
Yeah, the bond market's 3 times the size of the stock market, so it's enormous.
I didn't know that. Is it really?
Yeah, it's enormous. Most of it, and that's why the U.S. dollar is so strong and the U.S. currency is so strong, is because it's so liquid on the bond side. So there's most of the bonds are government. There's mortgage, then there's corporate, and then there's like riskier corporate debt called junk. But in general, if you think about just as simple as like if you were lending your friend or your family money at a certain fixed rate, back then the going rate was 2%, 1%, something super low. So then if you lock that in and now rates are ticking up past 5, your opportunity cost is miserable because you're stuck earning this interest rate while the market is paying way more. So what most people do is you buy lots of bonds, because that's what most investors do, and you buy a fund. And what happens is when the bond yields go up, it's like a seesaw, the bond prices go down. So what's actually happening is interest rates are ticking up because of the Fed and because of supply and demand. You're actually losing money and or purchasing power on an asset class that's supposed to be boring and safe. And that's why people just sit in cash, because they're just like, I don't want that. So it's an interesting phenomenon of like, the stock market has been the best house on the block for a long time, in particular the US stock market. So that's where people are like, just give me more stocks. So there's always a way that you can use a trend following type approach to see trends in your industry, see trends in my industry. So it's pretty but we use math, and it's non-emotional. So it's not like I'm guessing this is going to happen. It's the math says we're in a downtrend, so let's act accordingly.
Got it. Okay. Let's pivot to some of that, because I think for anyone listening who didn't listen to any of our other podcasts, I think what you bring is, in my opinion, like a really fresh angle on what can be really confusing for folks who want to get into investing, especially into the stock market. Maybe, Scott, I know you put together the slides, so maybe like even bringing up a couple of these would be cool, because I think for people, if you're listening or you can watch this, definitely turn on the watching ability at this point, because Scott's got some cool charts that he put together. But Scott, I'll let you jump into this, because I love looking at this stuff.
So I hope this works. Let me just do.
Yeah, that might work.
Okay, that's a little bit better. So at Invest with Rules, and we use the same engine for IWR Advisors, our advisory firm. So at the very top, we judge the market based upon the US market. Think S&P 500, think small cap companies, think tech companies, and international companies. And we take a broad basket of stocks, and we say, based on math, at the very top, are we in a very strong uptrending market, or are we in a very weak miserable, scary market off to the far left is a 0. Despite how I feel, despite tariffs, despite DeepSeek uprooting all of AI, the stock market globally, based on our process, says we're at a 9.5 as of this moment. And to me, that means that get your head out of it, follow the trend, don't complicate it. We're in a strong market. And I know you kind of see this. This is a chart from a third-party website called FinViz, which is, they love to advertise, but it's pretty charts done by computer automation, which I kind of like, that the computer does the lines, not a human. So
okay, cool.
It is what it is. So you'll see that you've been kind of in a channel working your way, making higher highs and higher lows. And everything is just kind of working its way into this interesting kind of point where if again, probabilities, we're probably going to break up and out. Could we kind of sit back down and kind of chop around more? Sure. If you want to go through and listen to hours and hours of macroeconomic podcasts, and everyone's welcome. The hard part is it's really hard to know how to apply that. So if you did the Shane White and you took every single company, like your companies you support, and you look at the profit and loss and the balance sheets, the US stock market, the S&P, is expected to grow around 10% earnings this year. So if all is simple and there's dividends and earnings, so the market could, in theory, hypothetically go up 10%. The same is true last year, is expected to go up by 12% based on earnings growth of all the 500 companies. But the market loved the interest rate cuts, and then they call it an expansion of multiple. Like, what could you eventually sell these businesses for gets pricier. So what happens is the market went up 20%, primarily because of these super large cap companies, which dominate this index. So
I should know that off the top of my head, but is that what the market, the S&P finished last year, was up 20%?
Correct. And it was primarily driven by the top 10 Magnificent 7 stocks. They did great. And a lot of this under the surface, most stocks were up about 3 to 6%. So the market was dominated by, it's 30% of the S&P now is really 10 companies. So as long as they perform, the behemoth of Amazon, Apple, Netflix, Nvidia, Google, that whole crew, then everything's great. But that's why we keep trugging up and higher.
And for, the average person, I'm sure probably the same question I have. What can you get in layman's terms? Like, what are these lines representing? I know there's like tons of different things you can build lines for, but what are they? What are these ones here?
So there's a study called technical analysis, which primarily is price action. And I'll go through my little process. I think it'll make more sense, but very simply, what it's trying to do is connect the dots for you and try to use repeatable chart pattern recognition. This is our process, and it's very, I hope, straightforward. And it was derived, the very top section was derived by a very wonderful book called The Secrets to How to Profit in Bull and Bear Markets by Stan Weinstein. And there's 4 stages. And very simply, we use computer power to tell us where everything is. If it's a company or a basket of companies like an ETF or an index fund, very simply, we're all trying really hard to avoid the stage 4 declines, which is in pink. And if you can avoid that, you're going to save yourself an absolute fortune in the market. And very simply, that's when the short-term and long-term trend in down below is our invest with rules signaling process and our trends. So stage 4 is when the market goes into these huge corrections, these bear markets. It's kind of torture. Then eventually you go back to a stage 1 where you start to get some lift off the bottom. And we want to deploy as much of our capital as possible in these stage 2 green uptrending environments. We need a mechanism to say stop buying because you've missed it a little bit. So because of the newsletter and the advisory, this is just information. So in general, I'm going to use car analogies. So we want to avoid brakes, like you're braking the car, you're stopping. U-turns are interesting, but I want to go for gas signals. I really want short-term and long-term uptrends. This is where most of the big money's made. And then be careful when you get to these stage 3 topping patterns. So very simply, this is when the short-term trend is now down, the long-term trend is up. So we can kind of map everything. And then this is how I think of it is we tend to be a little bit more longer-term investors in general, because here's how I think of my analogies for the market and then as an investor. 0.5 to me, if you think, Shane, like we're driving on the highway, should you be in the left-hand lane or in the right-hand lane of the highway at the moment? Our opinion is you should be somewhere near the left-hand lane. You should be exposed to some risk. The market's really been profitable since that bear market 2 years ago. And we're kind of thinking like, do you go to the middle lane, but we're not there yet. If we come down here, there's that phrase, there's always a bull market somewhere.
Yeah.
We're just using technology and trends to figure out where that is. And if one's a longer term investor, you just simply try really hard to avoid stage 4 declines, these break signals. And if you're a shorter term investor, that's only when I would like, I think about as a trend follower, you kind of like you date positions. And if the courtship is going well and you're profiting, then you continue the courtship. But you're not necessarily getting married to anything, but you'd love to at least date for a year and a day so you can get better tax treatment from the IRS if you're using a non-retirement account.
Right. Okay. So this are my first questions. I'm just using my fund money account, my Robinhood account as an example. The big question I had here as I was looking at this chart is, so let's use Tesla as an example for me personally. So I've had Tesla, I want to say, I don't know, 8 years maybe is when I first started buying positions. Now, the one thing I know, this is just Robinhood specifically. Robinhood, I don't think does a great job of really breaking it down for you very simply to say like, here is how each position you purchased is performing. It's just like, they just group it all together to say like, what's your average cost been, which is not very helpful. So you almost have to do it manually when you do something like Robinhood. But with that chart you had, like I've just continuously added positions.
Mm-hmm.
Like I've really never sold it. Do you think, so that I would argue or not argue, I guess my question for you is, I'm missing out on some potential gains because I never sell when it goes down. But for a long-term investor, like if you take where my first position was 8 years ago to now, I don't know if I'm really not asking this question in a very good manner. I guess my point is like, yeah, is it like if like there's like short-term, there's long-term. Is there like super long-term? Because like for me, if like this account for me is like I'm not necessarily. There's a lot I'm learning from you. So there's probably things I should be doing differently, but also like I've always thought of it as like, I don't want to touch this money for God knows how long kind of thing.
Well, let's just say you believe in Tesla, you believe in robotics, you believe in solar and the whole thing. Let's call it a $1 trillion firm. You think mentally something in the back of your mind says this is going to be a $10 trillion firm one day. So you're really long-term. So how I would think about this is, your position probably has a very sizable gain since 2020 because that Tesla rocketed out of there. And what I would say is how I would think of it and how I would internalize it is if I had capital or I had some money to go buy Tesla. The question is, do I go buy Tesla today or do I go buy the turn? And what I mean by the turn is there's going to be a position where Tesla is right now. I just saw it on my slide. It's a stage 3 topping pattern. Long-term traders, no big deal. It's great. It's still doing everything you want it to do. It's up 4% today. That's wonderful. Eventually, it's going to make the turn and going to go from a coast right back to a stage 2 gas. And that's when you hit it. You hit it right as it's turning and making a comeback. So you're just adding money, not kind of blindly, not when it's falling like a knife, but you on the turn when it's coming back up. And these signals the math just says, if you're interested, go get it.
Got it. Okay. So I guess that it doesn't necessarily, maybe one thing I misunderstood, it doesn't necessarily mean every stock always has to go stage 1, stage 2, stage 3, stage 4. You could go 3 back to 2.
It typically does. It goes back from 3 to 2 a lot, especially in a really big run with a really big winner. And then the likelihood of you getting a stage 4 is because you're in this huge gain. It's very unlikely. So you're now kind of rotating.
Got it. Okay. That makes a lot of sense. So I'll give everyone listening an example. Like I put some money in every month. I honestly have like a list outside of what Scott recommends where I'm just bullish forever. And I don't think anyone on here is going to be shocked. It's like Amazon. I'm just continuously thinking they're just getting bigger and better. Costco. Like I'm me and my family, we go to Costco way too much, but it's one of those ones where they just keep adding stores. The business model makes a ton of sense. I'm bullish on it. For things like that, it's instead of just willy-nilly being like, okay, this month I'm going to put X here to Costco, X to Amazon like I always do. it's like pay attention to where these are in this cycle. And maybe this month it should be a lot more into Costco. Next month, if phase two is actually more in Amazon's favor, put way more into Amazon. That makes a ton of sense. And then mathematically over time, that would make sense. That would add up to be and compound to be a lot more for you.
So we do give members more colorful charts of when the signals change. But so as an example, Amazon's under a teeny tiny bit of pressure. It's a quote. It's a COAS. Full disclosure, I own it. Our advisory owns it. Our newsletter owns it. We're not selling it. It's a COAS. It just means don't deploy new capital yet. And eventually, it's been a long-term uptrend for 189 calendar days. So it's done nothing wrong as a longer-term investor. And if you kind of go back, that was August of 2024. So right here, it signaled, hey, long-term looks great. And then more recently, it just had it's kind of topping a little bit. So it's saying, you know what, just be patient. And eventually, let's say it comes back up to, I know buying higher is like, why would he ever do that? But you're looking for confirmation that this little downtrend is over, that it's not going to sink like a rock. So Amazon to us is like, it's done nothing wrong. If I go to your Costco, which we all shop at way too often, this one's interesting where 629 days. So you're looking at almost 2 years, you've been in an uptrend. It's made 100%. But 27 days ago on Jan 17th, it said, hey, something's different here. This is when you want to add a teeny bit more capital if you're interested. Again, manage your risk. So then what it says is, so here's your gas signal, and it's gone from 950 to over 1,000. And then it says overheat. It says, don't add any more. So you'll notice that it's gone almost parabolic, and maybe it comes back down a little bit. So the mechanisms that we've built, whether you're a self-directed investor that does their own due diligence, or we just use these tools personally, we would go after like a Costco or an Amazon when the short-term trend is really right on the turn.
Got it. And I don't want to send us down a rabbit hole because I know this will get way more complex. But I'm always trying to learn from people like you on this. When you see like an overheat for someone who's maybe like a long term, is that ever? Tell me if I'm totally off here. Is that also when you could think about like shorting a stock?
I wouldn't. No, I would say my opinion is I would stop buying. If you're a super fast trader and it like something looks like a hockey stick and it goes straight up to the moon, I would maybe take a little bit off, but I personally wouldn't short a stock like that, just simply because we track what billion-dollar funds are buying, and I don't want to go against the grain. And I personally don't short individual stocks because they can go to infinity up and they can only go to zero down. So if I ever do hedge, I would like...
Oh, that's a good analogy. Yeah.
You can lose everything. I'll share a really fun story that I think this is fair to share. So and it mentioned everything, but I do hedge occasionally when the market's way further deteriorated using super low cost indexes they're inverse, but no leverage. I won't go into too much of the weeds, but I'll share an awesome story. I had a client at my prior firm, no information will be passed, but they were really wealthy. And this person had a sizable short on Tesla, and this was around like 2014 timeframe. And if you remember, it like 10x right soon thereafter. And I was just they didn't need me. I mean, they were so wealthy. It was like wildly wealthy. And my comments to him were, I don't think he ever picked up the phone to anyone that's ever been in my role ever. I just think it's like, okay. Who are you? And I just simply said to him, I go, I have just one question. Why are you shorting Tesla? And he goes, it's overblown. It's expensive. I don't like it. And I go, have you ever test driven it? And he's like, no. Have you ever seen people's reaction after they've test driven it? And this was, again, like way long time ago. And he's like, no. Yeah. I go, I think you should go down there because the last thing I want to see is you just wipe away a ton of money just because of what your belief in the balance sheet is. And sure. I think he finally started communicating with me because when you have that many millions, I'm talking like several hundred, like they don't need people. So they don't need new people. So it was one of those things where I was just trying to be like, be careful shorting individual stocks. That goes for everybody.
Okay. Got it. Okay. That's great advice. And I've had that exact same experience personally. I remember It was 2 summers ago. It was the first time I ever sat in the front seat of a Tesla, and we did self-driving all the way home from a golf course. I was mind blown. I'm like, I've been investing in this forever, and I've never been in one, and now I'm a lifelong believer. Like, it's so crazy.
Yeah.
So anyway, okay, got it. That makes a ton of sense.
So I will. Okay. So the S&P 500. So if I go there, this is why we say gas. So this is why it's in a short-term, long-term uptrend. Everything's great. So, until that changes, then I'll change. But so in general, the U.S. stock market 9.5. We're in the left lane. We can always change. Again, there's so many things in the news that are designed to sway you. But what is the math of the price telling us? And we look at relative strength. We look at momentum. There's just fancier technical terms for what's the movement of the price. And that's the supply and demand on display.
So maybe a dumb question, but I'm curious. I love the belief system around using math and less emotion. I mean, obviously with investing, I've been in the shoes of using emotion and it backfiring, especially around COVID. I think we had it in the podcast the first time I told you that. Like, it's the only big sell-off I ever did, and it was like the biggest mistake I've ever made with investing. But I'll never forget. On the flip side, though, are there things that do you believe like doing it this way captures, I don't know, weird things that are going on in the media that people do unfortunately pay way too much attention to and end up selling things off? Like, I mean, the tariff one's probably the best recent example. Like, was that something that doing it this way can also capture? Like, can you still capture those swings even though that's not like or is there still like a mathematical way that it's getting caught this way?
That's a really, so I guess, so the question is really just like, will it catch even like something as small as like a tidbit in the news?
Yeah, because like I think most people that don't know you or don't know your process, I would guess that most people listen to this, like when they've bought and sold stocks, it's probably off of emotion and they're not doing any arithmetic.
Mm-hmm.
So I guess the question is, doing it this way, it obviously follows what billion-dollar hedge funds are doing. It follows what people are actually doing behind the scenes, which is what, if you're a small individual investor, that's a great way to do it the right way, versus trying to just, as you said, cherry pick yourself. But do you feel like, is there any, I guess the question would be to flip it, make more sense for the listeners. Have you ever woken up and been like, shit, this completely, like, I thought it, like the math says gas and it actually was a correction a couple days later, and it maybe was because of something emotional that half the market listened to, which is like tariffs, like Trump coming out and saying something around tariffs and everyone sells off?
It's a really great question. My answer is, when it comes to like a basket of stocks, typically they don't react that fast. So the short-term trend is designed to move relatively quick. Think of it like 30 days on a daily chart. So the baskets don't tend to move that fast. But we have rules, invest with rules. So a stock reports earnings 4 times a year, and no one under regulation is supposed to know what the results are unless that's illegal.
Right, before they're announced, you mean?
Yeah, so it's all supposed to be unknown information, and then they release the data, whether in the morning or afternoon, whenever they report, and then it's like fireworks. And a stock can gap up, and it could be amazing and magical, or they can gap down by 15, 20, 30%, and it can feel just awful. And those are when, so we have rules around that type of catalyst because we know something big is going to change and the signal can change. So as an example, our rule is we don't buy anything 2 weeks before earnings. So if we know it's coming, just wait. Life can be long, so just wait. So the other part is, okay, we want to have a little bit of a gain. So let's say that our risk, so everything is measured and mapped. So let's say that our risk is 8% is the max we're willing to lose on this position. So we can win infinity, we can lose 8 to start. So what we would simply do is would say, okay, going into earnings, do we have a unit of risk? Are we up 8%? Are we up 16%? So in this example, if we have a cushion of gains, we'll hold into earnings. And if we don't have a cushion of gains, we'll either minimize or sell the position. And even if we love it, it's just, why wake up and be down 25% if you can avoid it?
Sure. Yeah.
So
yeah.
we play with a cushion is how we play really large catalyst events. Yeah.
Got it. Okay.
And my other comment is, like, tariffs will move things a little, not enough. DeepSeek did move things a lot. So when DeepSeek,
I went on vacation right as this deep
Yeah, I think the unknown is a lot of these mega cap companies spend a fortune, billions every quarter on their AI infrastructure, on their hardware and their energy cost to support it all. And then they're actually paying a lot of money to train they bought all these chips from NVIDIA. Now they have to train all these chips to do what they want it to do. And then the next question is, well, does it cost billions to train or does it cost a single digit millions? And that flipped it on its head and said, okay, well, has everyone been overpaying? And can you do this with software? And do you need the most expensive Blackwell chips from NVIDIA? And then you have these gap downs, which is very Catalyst like. So no one really, unless you magically saw this, that's amazing. So what you've seen is a lot of the semiconductors have fallen pretty hard. But I would say that's where it's frustrating, where like when we had like a 30% gain in a position and you wake up and you're up 10, you're like, where'd that go? And you're just like,
Yeah.
and if something isn't broken, we can keep because it has a cushion of gains. But if it didn't, but I would say that type of reaction, most people from my past would react on emotion. And what we do is we follow a process.
I love it. Yeah, I mean, it makes sense. Following the process, especially with anything when it comes to money, data in general, I think is obviously the right way to do it.
Oh, I one funny, super funny.
Yeah, go for it. Yeah, go for it.
So he's a good guy, but one of my buddies from college, he's like, what do I do with NVIDIA? And you're like, I don't know his situation financially. I don't know. And I just simply like tried my best to be somewhat helpful. But one of my funny things that I highly doubt they're going to watch, but my mother-in-law and my sister-in-law were talking the last holiday over Christmas about buying NVIDIA. That's when you know, it's like, you know, that quintessential, like the taxi cab driver is telling me to go buy something. When my mother-in-law and my sister-in-law are buying NVIDIA, the trade's not over, but it's really close.
That's such a good.
Yeah, it's going sideways from here on out, or eventually it could come back at some point. But is it going to hockey stick up from the moment my mother-in-law and sister-in-law know about it? No way.
No way. That's really funny. That's a good analogy because I think that is so true. Like I feel like I still am telling people and teaching some people in my circle about even things like ChatGPT. And every time I explain what it is, I'm like, how do you not know this? How am I in some weird world that you guys don't exist in? Because I feel like I've been doing this for a year at least, plus maybe more than that. Like, I don't know. Anyway, it's so funny. That's so true. That's a great way to think about it. That's so funny. Scott, as we winding down on time, the two questions I love asking, I've asked you a couple times, so I'm sure they're going to change, which is always exciting. And as your world changes, I'm sure they'll evolve, but you obviously have some cool books behind you. For everyone listening today who either A, wants to learn more about this process, or B, just wants to honestly learn more about this world. I think everyone to some degree wants to learn more about finance and investing, and whether it just depends on your level of wants and level of need. But do you have any books, articles, podcasts, any source of knowledge for the audience today that you'd recommend is like, hey, this is a good one to go read or go listen to?
Yeah, a couple of for you. So I'd say the most popular writer on trend following is Michael Covel. Some of his books are over my shoulder. One of my mentors, who's a kind of a growth stock picker, was William J. O'Neill. He's recently passed away, but his Investor's Business Daily. But he wrote the book How to Make Money in Stocks. And it sounds like kind of cliche, but it's a great book. It's about a set of rules to identify companies that are growing extraordinarily fast. Those are some of my favorites that I'd maybe start with, and then you'll probably get pretty interested. But I have one more that I think you'd like is One Up on Wall Street. There's Peter Lynch. Have you ever heard that name?
Yeah, I have heard that name.
I used to work at Fidelity. He was a really famous Fidelity guy. And he used to trail his wife in the mall and watch what she would buy. And he would find 10x ideas by just simply watching her spending patterns. And it's kind of that he invented the buy what you know. So I would say that's an amazing way to do it. If you think back, like how many years ago were you subscribing to Netflix and you had your iPhone and you're like, how did I not buy more of this? And
100%.
Yeah. And like this.
Well, you know what's funny though? You said, I agree. First of all, 100%. Where I think back, and it's funny, is I've been one of those people that I just try to my portfolio. I was talking to a buddy the other day, and he's like, "Yeah, I have 6 stocks in my fun account," and I'm like, I have like 300 stocks in my fund account. So I might be just over diversified, but like my thought's always been like, just get a ton of diversification and it'll all move in the direction eventually. Like just, you're not going to have crazy big days, but you're not usually going to have crazy big lows either. And you're just going to hopefully follow, but it's like similar to just buying an ETF or a, index fund.
That's what you've done.
Yeah, exactly. That's kind of what I've done. But, I guess like, yeah, I guess the pushback, not pushback, but just like the other side of that coin is like how much would have been added, like what you had to invest, like what percent should you have risked on like a couple of like handpicked stocks? I think it's always like the question, right? Because I agree. Like you think about Netflix, you're like, shit, should I put way more in? But at the time, you're like, there's so many good ideas. I don't know.
Yeah, it's a great question. I would say that a lot of stocks are correlated. I mean, they move similar ways. So the more you have doesn't necessarily mean it's like really spreading the risk that much more. So we've done an enormous amount of back testing, and we typically have kind of at around 20 or so positions.
Okay.
5% is the holding, 5% positions. And it's enough to move the needle when it does great. And it's not so big that it will let you stay up all night and worry. So there's got to be a mix for someone that they're comfortable with. I mean, yeah, if you think about, so how I would go through that is like I remember like we were getting 3 DVDs mailed to us constantly from Netflix. Can you imagine buying at that price at this point?
I know.
And you buy, so what we do is we would look at the trend roadmap, we look at the trends, we would look at, are these huge funds buying using our process? And if all the Venn diagram and all the stars line up, then you can go to a position that you can sleep at night, but you have a known risk. And then if it works, then it could potentially shave a few years off of working.
Got it. Okay. Love that. I love that. Last question. How do you organize your life? So like all the way down to, what does Scott want to achieve this year, down to what's the stuff you're doing today to build towards your goals? Are you still pen and paper? Are you using apps? What's it look like to like organize your life and get shit?
This is a hard one. I have read way too many books and I've struggled. I'm currently on Google Sheets. Is where I'm at.
Yep.
Because I can access it from my phone. I force myself. I always want to grab the pen and pull it down on paper. And I'm just like, don't do it. So yeah. So the answer to your question is Google Sheets. If you have any tips, I'm all ears.
I've been using this it's called the Full Focus Planner. I will be honest for everyone listening. I've talked highly of it. I've had the founders of it on here before. It's awesome, especially when you're starting something, to get you to like actually make tangible progress. I'm with you though. What tends to happen with me, the whole point of it is you have like your goals and then you have a weekly big 3. So like bigger picture, like what's 3 things this week? If I got these 3 things done, we moved towards the goal. I think just doing that and getting in a process, whether you do it in a journal, you do it in Google Sheets, you do it anywhere, that's been transformational for me in the last 5 years.
Nice.
And then each day you do the same thing. It's like, what's my big 3 today? What I've struggled is like, I have my podcast stuff. I have like our business for Noble. Like we have a whole system between us and our team. Like there's just a lot in there. So like, I think what something like a planner falls short on is you need to be able to see everything that could be done. And then this helps you distill down to what should be done and what's the priorities. I haven't figured that out yet. I'm constantly tinkering and trying to figure it out. I think honestly having something like a Google Sheet as like the place where everything gets inputted, and then using something like this daily where it's like right in front of me, I can't be distracted. Like where I struggle with Google Sheets, I do that. That's where our team uses. It's just like another thing on my computer, like another window open. So I just tend to I have ADD. So I'm like, I get distracted. So anyway, I love this. This is a simple tool for me. I mean, it's very tangible. Like I get to the end of the week and I can see how many days like I actually got my big 3 done. It's kind of remarkable. You'll realize there's days where you're like, oh, I can get those 3 things done when it's first thing in the morning. And you get to the end of the day and you did a bunch of other shit and you didn't get those 3 things done. And so if you can transition yourself to focus on the big 3 things more often, you realize you can hit goals. It's not about taking huge home run swings. It's about like getting like singles and doubles frequently is what I've learned.
Nice.
And so that's my process. But I think Google Sheets is the OG. I've tried like all of the apps and all the things out there and nothing beats Google Sheets. Is just customizable. It's simple. I love how it can be on your phone. Share it with people, add links. Like it's hard to beat. Google Sheets is simple. It's the best.
Yeah.
Scott, thank you for taking the time today, man. I will add all the links, but for everyone listening, who doesn't see the show notes, what's the best way for people to follow along with what you're doing and get a hold of you if they're interested in learning more or using your products?
It was, again, awesome to see you. Thanks for having me on. If you go to investwithrules.com and you put your name and email in, very low pressure, I send you the link to the S&P 500, the trend roadmap that what we saw today. So you can have it. It updates every day when you hit refresh. So I would love for you to be on the right side of the trend, do extraordinarily well, and be successful. That's the plan. And then again, yeah, it's just occasionally I send out maybe one email every 1 or 2 weeks just to keep you in the loop. But yeah, I hope it's really helpful.
Awesome, man. Well, it is. And I appreciate you taking the time, prepping for this and all the stuff you shared. I appreciate it as always, man. And we'll stay in touch as always, and best of luck.
Awesome. Best to you and your family.
Thanks, man. I appreciate it.
Yep.
All right. See you.